It's about a structure that you're putting in place is not welcome for the other side. So let's take a look at three problems with this. Number one is a weak structure makes good ambition harder to back. And when I say harder to back is when you are raising capital and you don't get it. So following the example from last week, where the fundraising was the priority, not the infrastructure supporting it. The route in this case is very simple. Review your entities, check where the assets are, your intellectual property, your patents, your contracts, your commercial rights seats, where they sit, in which entity, in which geography, in which country, which is the regulated environment of those commercial rights, right? So if you don't have, and you cannot explain this, and you are raising capital, it's not a pitch deck anymore. You have to provide evidence of all these things. And that's where things start to get messy and very difficult, because they say, why you need all this? You are auditing my company when I don't need the audit. I just need the capital to keep moving. Well, guess what? I will mention this again and again and again. It's not about your ideas anymore. It's not about your philosophy. It's not about how you see the world. It's about what the world wants to see to provide the tools that you're looking for, in this case, capital. So decide what moves, what gets licensed, and what stays where it is, right? So some things might move, other things might stay where they are. That is not paperwork for its own sake. It affects many things, and why the capital is difficult to grasp. It affects the taxation, it takes ownerships, affects accounting, governance, investors' perceptions, the future capital raising, because you might have a very difficult but at the end successful round. When you go into the next round, probably you will have a even harder and almost impossible way to do it, a capacity to do it, because the first round was already in the wrong structure. And in the long run, if you want long run, I'm not talking about years down the line, I'm talking about 3, 4, 5 years, when you try to sell or you try to bring another partners or equity, etc., that even would go much difficult, because the companies or the partners that potentially can partner with you in terms of equity or shareholders or going public or whatever is the case, they will say, unfortunately, this is not a company that can go that route, and we are not going to get involved here. And that's a problem for some founders that are too enamored of the capital raise that they cannot see the danger that they are creating.